Time now to turn to precious metals expert Andrew Maguire. Andrew, welcome back to the Keiser Report.
Max, it's always great to be here.
All right, we're talking gold again. And I think first I want to just ask you a question, see if you agree with this. You know, people understand what happened back with Northern Rock. When it collapsed, there's a run on the bank. You know, people were lined up outside the bank. Give me my money, because there was a panic that because of the fractional reserve banking system, not everyone's deposits are there at the same time. There's a panic. They go to the bank. Isn't this what we're seeing in the gold market? Isn't there essentially a run on the London Bullion Markets Association right now?
Absolutely there is, and we've got lots of evidence for that. So, I mean, I think, you know, you had an excellent interview, I know, with Alistair MacLeod on Saturday, which I looked at. And I want to say I want to agree with everything he said. I think what we try and do is try and keep it really simple as to what all this means. I think what we're seeing is essentially, we talked about backwardation, and I think a lot of people start to glaze over when we talk about all the technicals. But in simple terms, what we're seeing now, as evidenced in GOFO rates, which have been described by Sandeep Jaitley extremely well, and people can go back and look at your other interviews and look at what exactly that means technically. But essentially what it means is the bullion banks right now are having to pay a premium to buy physical. Now, that's unusual. I mean, we were in backwardation in GOFO rates for the last 15 days, and possibly it's too early now to check, but probably 16. That's unprecedented. And what it means in reality is that there is a run on the bank. The bullion banks are having to go out and pay a premium to buy bullion. Now, given the fact there's no producer hedging going on of any size, which might explain some of that, really what we're saying is they're actually going out, paying a premium, buying bullion to provide bullion to the market because there's a shortage of bullion.
Well, there's two things going on here. There's a shortage of bullion going on, and a lot of drivers to that phenomenon are happening on the central bank level and the big macro level. But there's something else going on here, which is that what you're saying here, technically speaking, is that for traders, they could sell their spot gold today and essentially buy it back in the 3-month contract for a locked-in arbitrage profit. But because they are so uncertain that they could buy it back in the future, they're not even willing to pick up the free money that's being availed to them with this arbitrage. That's backwardation. That's completely abnormal. That's a telltale sign of a market that's in stress, duress, correct?
That's absolute evidence. I mean, there's the bottom line. I mean, why would I, in the month of July, we're still in July here, average about $1.60 an ounce a premium spot, which is the cash market in London. And I'm not talking about Shanghai, I'm not talking about Vietnam, where you can get between $6 and $100 premiums an ounce. I'm talking about London, the global market, the global marketplace for gold. So it is a true benchmark, i.e. the fix comes up to this morning, whatever the price is what I can sell or buy my bullion for. Now, why as an arbitrager, why as a bank or a hedge fund or somebody in the profit business, wouldn't I take, and it's been up to $2.15 a matter of days ago, but an average of $1.60. Why wouldn't I sell 2 million ounces today, give my bullion over, take up to a $2 million profit, and not wait 90 days, the contract's about to expire, I could wait less than 30 days and get my bullion back. Well, as you said, why not?
Because there's no confidence that these markets like the COMEX and the London Bullion Market Association are going to survive another 30 days intact as we know them.
Yeah, and what I'd be worried about is me getting my, and I believe if we're talking a default here, essentially what we're saying.
That's right. We're talking about the long-rumored, anticipated, talked about default on the COMEX or London Bullion Markets Association, but based on market in the action, the run on the bank, it's either at hand right now or another extraordinary event is about to take place.
Yeah, well, it's on now, and I think, you know, here's the interesting part. On April the 1st, we saw the ABN AMRO default. It became public because a client of mine, and I think other clients, suddenly came onto the marketplace and said, or came to the press and said, well, hold on a minute, I can't get my bullion back. You've got faith in a system that's been held. People have said, look, you know, go to the London Bullion Market Association. I've got two kinds of ways of storing my gold. and they steer you into an unallocated contract because there's no storage costs, much cheaper. You know, we'll just give you a piece of paper that says you own this. Suddenly, we know for years and years and years we've had suspicions about the leverage, the 100-to-1 leverage of paper to gold. All of a sudden, ABN AMRO comes out and actually is the first LBMA default. The very first. So
right now, the timing on this goes back to your testimony to CFTC about the fact that these markets are trading at 100-to-1 leverage. When you went and testified to CFTC about the alleged manipulation in the silver market, it came out in testimony from the other side, almost by accident, mentioned that there was 100-to-1 leverage on the LBMA, which up until then nobody was really thinking about. And then it seems like from there, Germany wanted their gold. You know, Ambro went into fall. You know, you really set in motion a chain reaction, Andrew Maguire. You are the whistleblower extraordinaire in this space. So now what you were imagining was going to happen, you know, 6 months ago, a year ago, is all happening right now. So I'm sorry to interrupt. Continue.
Yeah, really. So really, there we have the default. Now, what happens is that suddenly the Fed, the BIS, the Bank of International Settlements, the central banks of central banks go, holy smoke, we have a problem. We cannot afford to have a bullion bank go down. If there's a run now, immediately you've got one default, what's going to happen? Everyone's going to do your Northern Rock thing and line up, I want my bullion. That would collapse the three major bullion banks in London, which would collapse the entire global banking system as we bullion banking system.
The three major bullion banks are, I would imagine, three of the four biggest banks, right?
Absolutely.
HSBC.
JP Morgan, Goldman Sachs. I mean, yeah.
So it's not just the U.S., it's the three biggest bullion banks
in London.
In London from both sides of the Atlantic.
And bearing in mind there are 6 bullion banks that clear the LPMCL, which is the London Clearing Bank system, which is basically there's 6 bullion banks. Pretty much all of those control what's going on. They clear everything in London every day. But basically, so you've got now this run. So what happens is the Fed steps in and says, look, we rather than expose this whole collapse and also on top of it the whole fiat system being in collapse, what we'll do is we'd rather provide bullion to the market. So borrow it, and we're happy to continue to rehypothecate what we've got, which is already leveraged. As you say, people are asking for their bullion bank. There's already a problem. So what they do is they see backwardation. They go, the only solution that we can see short term is to dump the futures price. In other words, they provide so much synthetic supply into the paper markets, to the COMEX paper markets, that we drop $400. Well, here we go. Full circle, $400 lower. Where are we again? We're exactly at the point where we were when ABN AMRO went down, except for the price is $400 cheaper. All the weak hands are blown out. GLD has already dumped what it's going to dump. So where are we now? We're in an even worse situation, or rather, the central banks are in an even worse situation now.
Because what was unanticipated, Andrew, correct me if I'm wrong, but when the price dropped from $1,600 to $1,200 by dumping paper onto the market, it increased the demand for physical in Asia.
Absolutely.
So they were hoping that a lot of gold would come into the market, physical gold, by manipulating the paper market, because the paper market is the tail that wags the physical market. So by dumping in the paper market, people are going to sell their physical back in, and there's a lot of media press, bull market's over, get out, done.
Yeah,
totally. But what happened was the opposite. In Asia, people lining up outside the door to buy physical gold. Yeah. So the central banks who were dumping that gold to create that suppressed price are now short gold. And now, since the physical demand has not gone anywhere but up, they then are in a position of having to come back in to satisfy that physical demand by buying physical again, right? So it gets back to this point where you're in backwardation, right? Which is getting worse every day.
It's got so much worse. Before, we didn't have the gold forward offer rates negative. In other words, it didn't actually cost a premium for the bullion banks at that time to actually lend their bullion. So essentially what we've got here, to buy their bullion. So essentially what we've got here is a worse situation. And in fact, I liken it to the fact 13 years ago when Gordon Brown bailed out Goldman Sachs by creating by dumping all of Britain's gold.
Wait, Andrew, you've done it again. Everyone is fainting now. Everyone's watching this show, especially in the UK, because they were told that Gordon Brown sold Britain's gold, 400 tons, 60% of Britain's sovereign gold, for reasons other than bailing out Goldman Sachs. But it turns out, looking through the record and in retrospect, that in fact, that's exactly what he did. And they've lost, I think, over $1 trillion, not trillion, but a huge value in depreciation from gold since then. But just review, we've got about a minute and a half left.
Yeah.
Very interesting stuff. Review, Gordon Brown is bailing out Goldman Sachs by selling Britain's sovereign gold. Take it away.
It's $250 then. Where are we now? It's $1,200 now, $1,300 right now. So we are back in a position where gold is almost $1,000 higher than it was, and yet we've got the same problem again. So, and there's no willing sellers.
Because Goldman Sachs got caught short dumping paper gold.
Absolutely.
So then the Bank of England bailed them out.
Bank of England bailed
And
them out.
now we find out from Alistair McLeod, who was on Keiser report just recently, saying that Bank of England is 1,300 tons have gone missing. And you're saying, if I connect all the dots here, that was sold into the market to take care of Goldman, these other bullion banks, including Goldman, doing the exact same thing all over again, dumping paper money, hoping that they would get people to scare out of the gold, but instead they did the opposite. They want physical gold. Now the Bank of England it has a liability here, a huge liability, correct? And these bullion banks, they're going to be insolvent, yes or no?
Yes, they are. And the Bank of England has to step in on a daily basis at the fixes and make up any shortfall. Out of the 600 tons of gold cleared by the LPMCL every day and the 5,000 tons of silver, incredible amounts, but that's what trades through the LBMA every day. They step in when people actually have the audacity to ask for their physical at this discount. The Bank of England has to step in and provide that bullion on a short-term basis.
Now, when the Bank of England and the Treasury and George Osborne, when they fail to match the books at the end of the day and there's leftover, doesn't that just get through the circuitous nature of these insiding deals? Doesn't that just end up on the debt of the UK?
Absolutely, and they're going to stroke an electronic check and they're going to pay everyone off, and anyone that hasn't got their physical, the reason they're not arbitraging is the day that you get settled in cash will be the day it gaps up $100, $200, $300.
All right, Andrew McGuire, thanks so much for being on the Keiser Report.
It's always a pleasure, Max.
And that's